Well, hi folks, Stratman from pipware.com here once again. This is the next video in the series on trading strategies. The first video was an introduction, is showing the three major components of any typical trading strategy, and they are basically price action, that's in terms of candle formations. Second component is moving averages, and the third component is typically an oscillator to filter out any bad trades. The second video was just a discussion on price action in terms of candle formations that I typically look at. This video we're going to concentrate on moving averages. As I said earlier, I in the first introductory video, I look pretty much to the 60 period moving average. That's what the coral of THV is, and when I first started becoming successful at trading, it was really through being part of the THV thread under the leadership and guidance of Cobra Forex. Thank you very much, Joe, for all you've done for me. It's been fantastic, and you continue to help others. You're a tremendous guy. So this is the coral that I've reprogrammed for the THV system. What I like about the coral is its multicolored nature, so it's pretty easy for new guys to see when price action is considered to be flat. Don't trade when it's flat, and downtrend red, uptrend green. So with moving averages, the typical rule is always trade on the same side as the moving average. In other words, trade away from the moving average. Trade towards the moving average at your peril. Okay, so that's the basic rule of moving averages. Again, just to reiterate, I use a 60 period moving average based on the THV coral. So here is the moving average here. Price is crossed above, so we're only looking for long trades using the THV system in this point. Long trades, even here when price action is coming back towards the coral, some of us might be a little bit aggressive and say, well, as long as there's enough distance from wherever we are here to the coral, could we trade? Like, I mean, if you got 50 or 60 pips here from this point, this reversal candle based on a reversal action, we could do that. Like, here's a 1, 2, 3 pattern. So you might put an order here. It's just broken the cloud. So this is a kind of a condition where you can break one of the coral rules, which is we're below the cloud, but we're still above the coral, as long as the distance here is large enough. Okay, anyway, let's investigate the whole moving average side of trading strategies a bit more. So if we just whiz on over to, I'm just uploading the video number 2 there. What I need to do is get myself a window for Google. I like Forex Factory. One thing that you can do when you're looking on the internet for something is you can, in Google, you can write what site you want Google to return results from by just putting site, whatever the name is. So in this case, I'm looking for a trading strategy called 3 ducks, and I'm saying we'll only look in Forex Factory. So here we go. Let's try and find the 3 ducks trading strategy. Here it is. Well, it says this system is great for new traders and old traders, so maybe it'll be okay for me. In fact, it is okay for me. I've checked this one out quite thoroughly. I really like this strategy. This strategy is totally based on a 60 period simple moving average. And the idea is to put your 60 period simple moving average on multiple time frames. So let's just do that right now so that we can see what a 60 period moving average looks like on all our time frames. So we're just going to add a moving average, and we're going to call it a 60 period. We'll make it white for now. That should stand out quite well, and we need a simple moving average, and we usually base our moving averages on the close, and we're going to have it that thick. So here we go. So let's have a look. So typically, I'll look at all the time frames, but if we look at the 60 period moving average, what you can see is that price tends to respect this moving average. In fact, to be honest, if just about any moving average you put on a chart, you could probably follow a line and see where price bounces off it. But I like to think that maybe the 60 moving average is a good one for that happening. So 60 moving average, if we had to trade it away from this, In other words, long all the way up to here, we would have made some serious money. And if we had a trader short on the daily chart all the way, and we're still going short here, we'd make some serious money. So moving average, really good. So now let's change over to the H4 time frame. I mean, look, it's looking a little bit choppier here, but still a good moving average. So that's the H4. Let's have a look at H1. Now H1 is looking quite interesting. Let's just move up here. So remember trading, so if we traded towards this moving average, like I said before, do it at your peril. Make sure you've got enough distance there. Here we'd be trading short. Once it broke through here, we'd trade long. You could trade towards there, it'll be a danger. And then trade short below this. So just have a look at it on a couple of other time frames. M15, well, M15 looks good. I mean, on the M15, it seems to be bouncing quite well. Go down to the M5. Okay, M5 price action. There's a good one for trading kind of long. It's quite a distance away from the moving average, whereas everywhere else you would be trading pretty much short all the way down there, and then long once it's above. But not significant moves here. What I typically do is I trade on the M15 time frame. So one thing you could easily do is you could add as per. Let's just go back to this because that kind of clarifies things a bit. So what this guy does is he puts a 60 period moving average off the 4-hour chart. He looks for the one on the 1-hour chart and the 5-minute chart. So 60 SMA on all those 3 time frames. Well, for me, I mean, I'm trading on the M15, so I'll probably use pretty much just the H1 60 moving average and the M5 moving average. So a way of doing that is to add 2 moving averages to your chart. So if we're on the M15, we have to consider what a H1 moving average would be. Well, the H1 is 4 periods higher than M15, so 4 lots of 15 go into 60 minutes. So we need to multiply this period by 4. So this becomes a 240 period moving average. And then we also need to add another moving average. If we add another moving average, and now we want the one from the 5-minute time frame. Now the 5-minute time frame is 3 times shorter than the M15, so that means that if it was a 60 period moving average, we'd have to divide it by 3, so we end up with a 20 period moving average. And so now we've got a chart with moving averages from other time frames displayed on our chart as per what this 3 ducks system is trying to point out. Look at these moving averages on all those time frames. The other one we could do is the H4 that the 3 ducks system says. So if we're on the M15 time frame, to get the how much does M15 go into 4 hours? Well, it's 4 times per hour, so it must be 16 times. So we need to work out what 16 times 60 is. 16 times 60 is 960. So we'd need a 960 period moving average to show the 4-hour 60 period moving average. So there we go, we've got our 3 moving averages on our chart. Now I like to take this one step further, because as soon as I go to H1, this all gets cocked up, because it's still using a 960 period moving average for one of them, and it's using a 240 period moving average and a 20 period moving average for the other. So what I'd rather do is, if I change time frames, I'd rather recalculate what the appropriate moving average should be, because taking the principle of when we're on M15, if we're looking at the moving average down on M5 and on H1, when we go to H1, which moving averages do we want? Well, for me, I'd probably be thinking about looking at the M15 60 period and the H4 60 period. So anyway, what I've done with the dashboard is I've made it a lot easier for you. So I've got the ability to have the lower time frame, current time frame, and upper time frame on, and you can choose whether it's SMA, EMA, or whatever, and you choose the period, and you choose the colors down here, and voila, you get your moving averages on there. So this is the higher time frame 60 period. This will be the current time frame one here, the grey, and the orange is the lower one. You can turn each of those off as you wish. And if you change time frames, it kind of automatically resyncs to the correct time frame. So there you go, moving averages.